Hello everyone. Let me introduce myself. My name is Dira Marsella with NPM 244120012 from Accounting Study Program. Here I will explain what an account is, account types, and how to input transactions into a journal. Let's watch the video. Definition of account. In accounting, an account is a detailed record associated with a specific item of assets, liabilities, equity, revenue, or expenses. Each account represents a specific element in a company's financial statements. 5 types of accounts and normal balance. Here are the 5 main types of accounts and their respective normal balance. 1. Asset. Definition. Assets are resources owned or controlled by a company that are expected to provide economic benefits in the future. Normal balance. Debit. Assets usually have a debit balance because increases in assets are recorded as debits, while decreases in assets are recorded as credits. 2. Liability. Definition. Liabilities are obligations or debts that must be paid by the company in the future. Normal balance. Credit. Liabilities usually have a credit balance because an increase in liabilities is recorded as a credit, while a decrease in liabilities is recorded as a debit. 3. Equity. Definition. Equity is the owner's right to the company's assets after deducting liabilities. Normal balance. Credit. Equity usually has a credit balance because an increase in equity is recorded as a credit, while a decrease in equity is recorded as a debit. 4. Revenue. Definition. Revenue is the gross inflow from the sale of goods or services, or from other operating activities. Normal balance. Credit. Revenue usually has a credit balance because an increase in revenue is recorded as a credit, while a decrease in revenue is recorded as a debit. 5. Expense. Definition. Expenses are costs incurred to generate revenue. Normal balance. Debit. Expenses usually have a debit balance because an increase in expenses is recorded as a debit, while a decrease in expenses is recorded as a credit. How to input transactions into General Journal. Here are the steps to input transactions into General Journal. 1. Identify transactions. Make sure you have a list of transactions that need to be recorded. 2. Determine the transaction date. Record the transaction date in the date column of the General Journal. 3. Identify the affected accounts. Determine the accounts that are affected by the transaction. This could be an asset, liability, equity, revenue, or expense. 4. Determine debits and credits. Use a double-entry bookkeeping system where every transaction must have at least one debit and one credit. Example: if the company receives $15,000 in cash from the owner, the cash account will be debited for $15,000 and the owner's equity account will be credited for $15,000. 5. General Journal Format Contents. The General Journal format usually includes date of transaction, name of the account debited and credited, debit and credit amount, a brief description of the transaction. General Journal example. In the example above, the first transaction records a cash receipt from the owner, which increases the cash account, debit, and increases the owner's equity account, credit. The second transaction records a rent payment, which increases the rent expense account, debit, and decreases the cash account, credit. That's all the explanation from me. Hopefully it can help everyone. Thank you.